Hi there, Assalamualaikum and good morning. So we are from Group 4 and today we will be presenting our group project for BAFB 3013, Subject Financial Management, Section MC032. So our presentation is based on the journal article titled Working Capital Management, Corporate Performance and Financial Constraints, written by the author as you can see in the slide and published in the Journal of Business Research in 2014. So in this presentation, we will first discuss the article review, including the introduction, summary, critical evaluation, and its application to working capital management. So after that, we will be presenting the solutions for two scenario questions, which involve cash budget and economic order quantity, or what we call EOQ analysis. So without further ado, I would like to invite our first presenter to begin with the introduction of the article. Thank you. So before we begin, I would like to introduce all of our group members. My name is Najmo Alfaris bin Najmo Alfarid. So together with me are Nurin Shafiqah binti Puno Hajar. Next is Christy Janice Corden and Kirtana anak perempuan Kandasamy, and lastly Nisha anak perempuan Dharmalinga.
Hi, Assalamualaikum. My name is Nuri Syafiqah binti Bunajar. The article I review is titled Working Capital Management, Corporate Performance and Financial Constraint, published in the Journal of Business Research in 2014 by Sonia Benes Caballero, Pedro J. Garcia-Turrell, and Pedro Martinez Solano. Working capital management refers to managing a company's short-term assets and liabilities, including cash, inventory, account receivable, and account payable. Effective working capital management helps companies maintain healthy cash flow, meet short-term obligations, and improve overall financial performance. In contrast, poor working capital management may result in cash shortage, increased financial costs, and lower profitability. This study investigates the relation between working capital management and corporate performance. The purpose of this review is to summarize the key findings of the article and explain the importance of effective working capital management in supporting better financial performance and decision making. That's all from me. Thank you.
Hi, madam. My name is Christy, and today I'll be presenting this second slide, which is the summary and critical evaluation of the article that we chose. So, for the first point, we have is research objective. The study examines how managing working capital affects the overall performance of UK non financial companies. The researchers wanted to determine whether there is an ideal amount of working capital that maximizes business performance. Plus, the study also investigates whether financially constrained firms require to work different levels of working capital. The second point is research methodology. The study analyzed data from 258 publicly listed companies in the UK and also a total of 1,606 firm year observations were collected over 7 years. And the GMM, which is Generalized Method of Moments, was also used to improve the accuracy and reliability of the research findings. And also, Tobin's Q measured firm performance, while Net Trade Cycle NTC measured working capital management. The third point is key findings. Firm performance improves as capital working increases up to an optimal level but declines if working capital becomes excessive. The ideal net trade cycle is approximately 66.5 days of achieving the best business performances. And also, the companies with limited access to financing perform better with lower levels of working capital. And the fourth point we have is strengths. Strength. Using GMM reduces bias and improve the reliability of the results. And also the study includes 258 companies and 1,606 observations, making the findings more reliable. The study also introduces the idea that there is an optimal level of working capital instead of assuming that more capital is always better. while several financial indicators were also used to measure financial constraints, making the conclusion more robust. And the fifth point we have is weaknesses. One is limited generalizability. The findings only apply to UK non-financial listed companies and may not represent firms in other countries or industry. The research uses data from 2001 to 2007, which may not fully reflect today's business's environment. And for the conclusion, working capital should be managed carefully, yes. Both insufficient and excessive working capital can negatively affect firm performance. And also, to maintain an optimal level, managers should aim to keep working capital at its ideal level to maximize firm value and reduce unnecessary cost. That's all from me. Thank you, madam.
Good day to everyone. My name is Nisha. I will be presenting the application to CL03 and the conclusion. Working capital management. The working capital management is the process of managing a company's current assets and current liability to ensure smoother business operations. According to this study, there is an inverted U-shaped relationship between working capital and corporate performance. This means that increasing working capital improves performance only up to an optimal level. If the company has too little working capital, it may experience cash shortages, inventory shortages, and lost sales. However, if the company keeps too much working capital, it will face higher financing costs, storage costs, and opportunity costs because excess funds are tied up in current assets. Therefore, managers should maintain an optimal level of working capital to maximize profitability and business performance. The next is short-term financing. The studies also explain that companies use short-term financing to support their daily business operations, such as purchasing inventory, paying supplies, and managing cash flow. However, the companies that face financial constraints should maintain lower working capital because external financing is more expensive and difficult to obtain. By reducing unnecessary working capital investment, companies can lower borrowing costs and reduce financial risk. Third is business implications. The findings suggest that managers should regularly monitor working capital and maintain it at an optimal level. This helps companies improve liquidity, reduce financing costs, and increase profitability. In addition, companies should consider their financial capability before deciding how much working capital they should maintain. Effective working capital management supports better financial performance and long-term business process. The conclusion of this study is that effective working capital management is important for improving corporate performance, companies' performance, best when they maintain an optimal level of working capital. Firms with financial constraints should manage working capital more carefully to reduce financing costs and improve financial stability. Therefore, balancing liquidity, profitability, and financing decisions is essential for achieving sustainable business growth. Thank you. That's all from me.
Hey everyone, my name is Kirtana Gandasamy and my metric number is MC2409299499. So today I would like to explain about the cash budget from January to April. So here we go. So first we can see that the cash coming in is increasing from RM 84500 in January up to RM 125000 in April. So overall the business is improving in terms of income, but the problem is with the cash going out. In January the company, so we can see here, spend more than it earned, which is cause a negative cash flow. So this show that the company has a cash flow problem and might struggle to pay in short-term expenses. To improve this, the company can borrow short-term money like overdraft, try to collect payment earlier and control spending more carefully. In conclusion, even though the income is increasing, the company need better cash management to stay stable. So that's all from me. Thank you for listening my speech. So I pass the slide to my next group member.
Hi, my name is Najmu Al Faris. So today I will be presenting the scenario for 7.2, which focuses on the economic order quantity, or what we call EOQ. So in this scenario, the company has an annual demand of 52,000 dozens, we compared the current EOQ of 1,317 dozens with an alternative order quantity of 2,000 dozens to determine which option results in the lowest total annual inventory cost. So if we can look at the table on the slide, we can see that the purchasing cost remains the same at 124,800 ringgit for both ordering policies because the annual demand does not change. So next up is the ordering cost will decreases from 789 ringgit 7 cents under the EOQ policy to 520 when ordering 2,000 dozens, since the company places fewer orders throughout the year. So, however, the holding cost increases from 790 ringgit and 20 cents to 1,200 ringgit because a larger order quantity means the company holds more inventory in storage. So as a result, the total annual inventory cost under the EOQ policy is 126,379 ringgit and 27 cents, while ordering 2,000 dozens results in a higher total cost of 126,520 ringgit. So therefore, we recommend that the company maintain the EOQ of 103 1,317 dozens because it produces the lowest total inventory cost. Although ordering 2,000 dozens reduces the ordering cost, so the increase in holding cost is greater than the savings achieved. So therefore, the EOQ policy provides the most cost-effective inventory management decision. So that's all from me. Thank you.